been learning about value investing, finance, just regular investment for a while now, but you don't know where to go next. You're getting confused about the vast amount of information on the internet. You don't want to waste your time on crap information. You want good information and reliable information. In this series of videos on value investing and finance education, you will find those answers to those questions and much more. My name is Jason Rivera. Welcome to Value Investing and Finance Education. Hey, Jason here. Today we're going to continue analyzing Tiffany after the buyout of Tiffany by Louis Vuitton for $16 billion. We're going to continue where we left off last time. Last time we finished doing the preliminary analysis of Tiffany. And I found out that, at least based on my preliminary analysis checklist, which you're seeing here, this company, I wouldn't research this company further normally. Today, though, or we're going to continue going over this case study because I find this buyout fascinating. Today, we're going to cover for Tiffany what these terms mean, why they're important, where you can find extra information about them, what clues they show you, what red flags they show you, that kind of stuff. Why these things are on the list, why other things are not on the list, all that kind of stuff. Because I went pretty quick through my preliminary analysis last time. I think that video was 20 minutes long. I didn't really explain much of these and what they meant and why they're important and why they're here and while others are not here, those kind of things. So in this video, we're going to do that today. So these two are here specifically just so I have this information. They're here for no other reason than that, except for market cap. Market cap is so I can go back in time. That's why I put the date up here. Market cap is so I can go back in time and see what at, let's say this is next year at this time of year, I can go back and see exactly what the market cap was for this company at that point in time. I don't have to kind of look at a stock chart or guess. I actually know what it was at that point in time. Dividend, just so I know it has a dividend. That's why that's there. Okay, operating margin. This is here because I don't use net profit when I evaluate companies. I've talked at length about that in other videos, which will be linked below. If you want to learn more about why I don't use net profit, go to those videos. I don't use net profit. I use operating margin or operating profit, in this case, the percentage, which is operating margin. And I want to know what this is not only in the trailing 12-month period, but also the 5-year average. I want to know these in connection with each other so that I can see if this number is higher or lower than the kind of average. If it is higher or lower, I need to figure out why when I read the financial statements. If it's higher, like it is here, over the 5-year average, so there's a decline in the trailing 12-month period, is this going to be sustained over the long time period? Is the 5-year average more realistic? If it is the company, how is the company going to get back to those margins? If it's not, why is it not? Is there a decline in the industry? Is there a decline or a raising in their costs? Is there a lowering of their pricing? Is there all these kind of combination of things show you, or you can learn from looking at this number? Because if costs are higher, margins go down. If pricing is lower, margins go down. The inverse of these is both true, or is true as well, but you can tell that from just these two numbers. Again, where those kind of issues might come up, if there are issues. In this case, I would want to know why margins are lower by 2 percentage points in the last 12 months versus the 5-year average, and which is more sustainable? Is this the kind of new norm for the company, or can they get back to this number? If so, how? Are they going to cut costs? Are they going to raise prices? Are they going to work to build efficiencies? Those kind of things. Okay. Share count. I want to know what share count is because I focus mainly on small caps, micro caps, nano caps. And share dilution can destroy those companies really quick if you aren't aware of what the share count is doing over time. Generally, I want to see this either stable or falling over time via buybacks if the company is undervalued. The only time I really want to see this raising is if a company has to issue shares and it can't pay cash. Yeah, after negotiations, it can't pay cash, and it has to use share equity, has to increase share count to buy an undervalued asset. That's pretty much the only time I want to see this raising. The reason is because if you are raising equity, you're not only diluting further shareholders or previous shareholders, but you're also, if you're not doing it well, if you're not allocating your capital well and you're buying overvalued assets, not only are you buying overvalued assets, but you're also destroying capital, shareholder capital, by buying an overvalued asset with equity. At least if you pay cash, the money's just kind of there and whatever, it goes away. But if you use shares and you buy an overvalued asset, or if you issue shares and you buy an overvalued asset, those shares are still going to remain after you buy the company. It's not just gone like cash. So pretty much always want to see this falling over time or stable at the very least. Very rare cases do you want to see this rising. And that's pretty much only if you know the company is a great allocator of capital, which there are very few. So that is very rare situation. Book value per share. Okay, I teach this to my masterclass and coaching program students. Book value per share. I don't really use it anymore, except for one specific situation, which is right here. Book value per share is important here because at a base level, think of what book value per share is. Book value per share is the money left over after you're subtracting taking assets and subtracting liabilities. The money left over, if it's positive, it is called equity, shareholders' equity, which is also called book value. I pretty much always want to see this raising over time because it's at a very basic level. Book value per share is the estimated intrinsic value of the company's assets or net assets. I'll say that again. Book value is the company's, or book value per share is the company's per share value of net assets after subtracting assets from liabilities. It's the net intrinsic value, basic intrinsic value of the balance sheet, essentially, is what book value per share is. It's a proxy for the underlying value of the company. So if you see this rising over time, it means the underlying value of the company is rising over time. I hope that makes sense. If you see this declining, the reverse is also true. If you see this declining, it means the underlying value of the company is declining over time. That can be for several reasons. It can be because of impairments, write-downs, selling of assets, not having as much liability, getting rid of inventory. It could be for a number of reasons, but generally, if it's outside of, let's say, an asset sale spinoff, selling a subsidiary company, those kind of things, in the short term, that will be bad. Look bad for the book value per share. In the long term, that might be best for the company because it might be a poor performing unit. It might not line up. If it's a spinoff, it might not line up with the company's goals, and that will lower book value per share. But if most of the book value comes from goodwill and intangible assets, you need to be very careful because those, in most cases, especially again in my arena of small caps, nano caps, micro caps, those have almost zero value. For companies, bigger companies, Coca-Cola, Microsoft, Apple, some of the giant companies in the world, intangible assets and goodwill can have an enormous amount of value, but still they can be written down and impaired if the company isn't doing well. So you need to be very careful with this. Almost always want to see it rising. Again, barring some kind of asset sale, spinoff, that kind of thing. You pretty much in every other case you want to see this rising because it's used, or at least I use it as a proxy for the very basic intrinsic value of the company. Why is that? Because at the basic level, as deep value investors, we look at balance sheet strength first. We want the company to have net assets, not net liabilities. We want the company to have significant cash, little to no debt. We want the balance sheet to be safe. If the book value per share is rising over time, it means the company is growing its asset base and growing the kind of underlying intrinsic value of the company. Yes, I don't really use this in any other case anymore because most companies nowadays don't, or most of their operational value is not based on assets anymore. A lot of companies, consulting companies, um, Apple to a large degree, Amazon to a large degree, most modern companies don't have pure manufacturing operations anymore. They do multiple different things. They are information businesses, um, all sorts of those kind of things where asset value and book value doesn't matter as much, but it's still important because we still want to ensure that the company has a safe balance sheet. Okay, ROIC, return on invested capital. This is a profitability metric that shows how well the company produces profits based on its assets. This is important. This is, if you saw my series a while back, probably a year ago now, on the 3 most important investing metrics, you'll see all 3 of them on this list. This is one of the 3 that I talk about in those videos, and I can link that video again below. ROIC, again, shows you how much profits a company earns from, in this case, operating profit. I use operating profit to calculate ROIC. So EBIT compared to its assets, or compared to its net assets. So I'm not going to get into the actual calculation today. We can do that in another video, another training. But this is one of the most important metrics. Generally, the higher you want to see this, the higher the better, because that means the higher the better, or the higher the number is, the more profitability the company earns off its assets. This is another way I measure how well a company, this is one way I measure how a company, or how well a company allocates capital, is by using this number. This number fluctuates widely depending on the industry. If it's a manufacturing company, hard asset company, any company like that, generally its industry or its margins will be lower. If it's an information business, if it's a consulting company, if it's a third-party logistics company, if it's a light asset business model company, these margins industry-wide will generally be higher. I also use this metric when I'm looking at a company and comparing it to its competitors to see if the company may have a competitive advantage. For example, if the industry average ROIC is, and talk about industry average, I look at 5 or 6 companies in the industry if I can, public company competitors, to find their ROICs. Let's say that's 10%. If the company or if I find a company in that same industry that has an ROIC of 20%, that company either has a massive competitive advantage that may be hidden and you need to research, or their numbers are full of crap, or they might have a slightly different business model. So this is a way to spot potential competitive advantages at a company as well. Very, 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 very important number. This is one of the most important numbers that I look at. We'll talk about the other 2 here shortly, and I'll link that series below this video. This is ultra important number. You can calculate a bunch of different ways. The most important thing is to keep your calculation consistent so you can measure it and compare it over time to companies either in your portfolio or new companies you're looking at, or again, industry competitors as well. ROE. Only time I use this number is to compare it to this number. Because if this number is higher than this number, I automatically know the company has debt on its balance sheet. How do I know that? Because debt levers ROE to make it and makes it higher than ROIC. Debt is leverage. Debt leverages things positively if you use it well, and you don't get too crazy with the debt, and you can pay it off with your operating profits or free cash flow. Debt can be a useful tool. But let's say this number is 12 and a half. Let's say this was 30. That would mean the company would have an enormous amount of debt. The higher this number is compared to this number, the more debt the company has. If this number and this number are the same, it means the company has no debt. This, I can tell just from looking at it, isn't a bad amount of debt. It's probably sustainable. I haven't looked at the financials yet, so I don't know what kind of coupon rates it has, but this is the only reason I use ROE, is to automatically know. As soon as I see this number is higher than this number, I automatically know the company has debt, and I need to figure out why, or to figure out how much on either in the balance sheet and the financial statements in the footnotes, or in the on Morningstar's website. Okay, here's another ultra important number. This is number 2 on the three most, I think it was the 3 most useful investing metrics series I did a couple years, or last year. This is number 2. This is the cash flow machine margin. I've seen it called before. Essentially, this is free cash flow divided by sales. This is important because the higher this number is, obviously, the better. The more cash flow the company produces based on its sale. I look for margins on this number 5% or above on a consistent basis. For ROIC, 10% or above on a consistent basis. For free cash flow to sales, 5% or above on a consistent basis. The more free cash flow a company produces, the better the company is. Not only from an operational standpoint, from a potential competitive advantage standpoint, but also because it means the company generates more cash, has more cash, or it can have more cash on its balance sheet. It can reinvest more cash into the company to grow operations, to do more marketing, to do research and development, to do whatever you want to do with the money. Free cash flow gives you options. Another reason it's important is because it gives you options to buy back shares, pay a dividend, acquire companies. High free cash flow generation gives you options. It gives you the ability to have dry powder, as Warren Buffett calls it, to be ready when something happens, so you don't have to take out bad debt at high rates, so you don't have to issue shares at unfavorable terms and dilute shareholders, so you don't have to sell a part of the company you don't want to sell to, let's say, a hedge fund or an activist investor, or whatever your situation is. If you produce free cash flow, you have the ability to stay in business for a long time. If you don't, you're essentially month-to-month business. And I even came across this with the companies I was helping in the UAE and private businesses I've advised, is some of them are month-to-month businesses, essentially, because their cash flow generation is so poor that if their customers stop paying them today, they would be out of business within 2 to 3 months. Some of the companies I was dealing with, actually many of the companies, pretty much all the companies I've advised to some degree, have had free cash flow issues, except for I think one off the top of my head. Some kind of cash flow issue that if customers start paying them, they would be out of business within a matter of months, not years. That's how important free cash flow is. Okay. And again, I do the same comparison here with ROIC and operating margin. I would want to figure out why this number dropped. So by about half this year compared to the 5-year average, I would want to figure out why. So this isn't only a checklist kind of on a preliminary basis to see and make sure these numbers meet my criteria. It's also an area of where when I look in the financial statements, to figure out why these are higher or lower or the same, and what is going to happen or what should happen going forward with the company as well. Okay, last metric for the 3 most useful investing metrics I talked about in that series, and I'll link it below, is this one, the cash conversion cycle. Almost no one I see talks about this, but it's insanely important, not just because of the actual numbers here that I'll talk about, but also because of the I'm trying to think off the top of my head, the 7 or 8 things this number shows you by itself. And we'll do in the next video on this, we'll do a training on the cash conversion cycle, talking just specifically about what all this number can show you, or what it does show you for a company, why it's so important. So I'm going to save talking about that until the next video, because I could literally spend an hour just talking about this one metric. That's how much it can show you. Generally, just until we talk about that though, generally you want to see this either staying about the same or falling over time, because it means the company is either really efficient or becoming more efficient over time. The opposite is true. If there's a rise, the company's becoming less efficient and it's producing less cash flow, or it's producing cash flow slower than it was before. So there's a rise, so it's producing cash at about an 11.7% slower rate today versus about in 2010. Again, we'll talk about more in depth in the next video on this, specifically on cash conversion cycle. But this number is insanely important as well, and almost nobody talks about it. Okay, EV to EBIT and EV to free cash flow. These are two minor relative valuations I do at this stage, just to kind of get an idea of if I should continue researching this company or not. Is it potentially overvalued, fairly valued, undervalued, whatever? In this case, all right. In this case, the company is massively overvalued based on these two metrics. At this preliminary stage, I usually look for companies to do further research on and potentially buy with these numbers under 8. So this company is massively overvalued, right now. And that is illustrated with the inverse, which is the earnings yields. Earnings yields is the amount of money, or the expected return you should expect to earn in the next year if you were to buy the company at today's numbers, using today's numbers. So if you are happy earning a 1.8% return or a 4.6% return, good for you. I am not. But so this illustrates how overvalued the company is. So let's say this was different. Let's say, just for argument's sake, this was 6, so that would be about 2.03. Okay, so let's illustrate this further down here. So 49.3. So now, if these were these numbers, and you could expect to earn a 49.3% return in the next year based on enterprise value compared to free cash flow, that's a company you want to research. Obviously, I mean, you don't see numbers like this very often, but if you do, just like the above, this immediately lets me know whether the company is overvalued, undervalued, fairly valued. Immediately. I can immediately see these numbers, and these numbers, all of this is for immediate knowledge. Plus, it shows you other areas to look for immediate clues. This checklist saves me an enormous amount of time. And I developed it over probably the last 8 years or so, and refined it to figure out, based on my criteria, what are the most important numbers in the shortest amount of time that I can figure out. Do I want to research this company further? Is it massively overvalued? Are its margins falling? What's going on with the company? All these kind of things. These are it, including some notes, some basic notes down here, which we'll get to in a second. This is it. I did this, if you saw the last video, which again, I'll link below, I did the entire analysis in 20 minutes, and I was going slower than I normally do. It used to take me hours to do a preliminary analysis because I had no system, I had no process for doing what I was doing. I would waste literally, again, hours and days of time trying to figure out which company's financial statements I wanted to read. let alone, and this is just at the preliminary analysis stage. So I was wasting hours there. I was wasting hours figuring out which companies to research, and I spent a lot of time in researching crap companies because I had no system, I had no process. This same thing will help save you an enormous amount of time as well. And I'll have a link below where you can download this and 4 other gifts that will help you become a world-class value investor faster. Value investing journey is dedicated to helping you become a world-class value investor within 1 year. And this downloadable sheet plus 4 other free gifts that you can get for free just by entering your email address, you can get below. I'll link that below as well. And this and the other gifts will help save you an enormous amount of time and help you find better companies, better investments faster. Okay, we'll talk about enterprise value in another training. Other than that, these are the only notes I take generally at this stage. And the only reason I do this is so, again, I can immediately know without having to look at anything, without having to look at anything on Morningstar, if the company's in a net debt or a net cash position. Again, balance sheet strengths, number one for most deep value investors. If the company has a net debt position, it means there's less margin of safety. The company might not have as healthy a balance sheet as you require. If it has net cash, the opposite is true. Might have huge margin of safety, all that kind of stuff. So I hope this helps. We'll talk about cash conversion cycle in another training, enterprise value in another training. But if you have any questions on the other stuff we talked about today, let me know. Make sure to check out all the other links if you want to learn along with us as we're doing this case study. Make sure to download this template and the other 4 gifts you can get for free by signing up, just putting your email address in. You'll get 4 other gifts that will help you become a greater value investor faster and help you save an enormous amount of time and frustration. I hope this helps. All those links will be below. I hope this helps. If you have any questions, comments, concerns, let me know below. If you're watching on YouTube, make sure to like, love, share, subscribe, and hit the notification bell so you are notified anytime we release a new video. We're releasing new videos all the time. Thanks for watching. Hope you have a great day. Talk soon.